On the morning of Monday, October 23rd, billionaire investor and hedge fund manager Bill Ackman tweeted, "We covered our bond short." Interest rates on US government debt immediately began to plummet. This was in stark contrast to interest rates having been climbing for years now and recently reaching multi-decade highs. This unexpected move has left many asking the question, did one billionaire actually just move the entire US Treasury market? But first, let's take a look at what actually happened here. And if you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I help active investors learn how to drastically increase returns while reducing losses. Back in early August of 2023, Bill Ackman disclosed that he was bearish 30-year treasuries via options. Bond prices and bond yields are inversely tied, and so when bond prices go down, that's the same thing as rates going up and vice versa. Because if you'd pay $100 to get $1, that's 1%. But if you'd only pay $50 to get $1, that's 2%. And so Bill Ackman was accurately looking at economic problems such as structural changes, deglobalization, the energy transition, persistent inflation pressures, and the government flooding the market with new bond supply. He was expecting all of these factors to push interest rates higher. If we take a look where rates were on long-term US government debt when he disclosed this bet back in August, they were sub 4%. By the time he disclosed it, they had spent a good amount of time building this position. He reiterated his trade in September, saying that he wouldn't be shocked to see 30-year rates well through the 5% level. He stated that it was his opinion that you're not being paid enough to enter into a 30-year contract with the US government at that fixed price. And if we take a look at long-term yields, we can see they did indeed push through 5%, with the 30-year currently still over 5%, earlier reaching as high as 5.17%. The 20-year is even higher, up at 5.2%, with the 10-year being at the bottom end of the yield curve, currently hovering just below 5%. With the 30-year though exceeding 5%, they did hit their price target, with seeing long-term government bonds increase through the 5% level. But on October 23rd, he announced that they had covered their bond short, meaning they had closed out their trade, no longer expecting or betting on rates to continue rising. Now, the average bystander may look at this and think, well, that means that he must think that the economy is in a better position now, right? Well, actually, what he cited was that there is too much risk in the world to remain short bonds at current long-term rates. And he added that the economy is slowing faster than the recent data suggests. Now, at first glance, this might seem completely counterintuitive. If you think that risks are elevated compared to when you opened up this trade, why would that cause you to reverse your decision and close out the trade? Well, basically, he thinks things are getting so bad that investors may increasingly buy bonds as a safe haven. That because of how bad things are getting and how much economic uncertainty there is right now, that investors may decide to sell other assets, buy US treasuries instead. All that buying pressure will lift the price of treasuries, which will push down interest rates, the yields on those treasuries. Now, you know that I have been bearish treasuries for a long time now, years now. I've been very vocal about that on this channel. I currently have open positions that are bearish treasuries, and we'll get more into how I'm actually playing that at the end of the video. So the question is, did Bill Ackman, one billionaire, actually move the market? And if we take a look here, just zoom out over the last couple of years, you can barely even see the drop in yields at the end of this chart. So while it's a big move from a day-to-day basis, this is not something that is extraordinary by any means, especially considering how frequently we see moves of this magnitude. The second thing is that this trade was already closed when it was announced. So for weeks, months, and days, yields have been rising. But on the day that this trade was disclosed that it was closed, that's when yields fell. So no, Bill Ackman, his fund, this trade itself did not actually move the market. However, there was a lot of visibility on this, especially concerning large investments or large trades like this. Bill Ackman tends to get quite a bit of visibility. As a result, you have algorithms, you have high frequency traders, you have retail, common, small investors, and you have everybody in between trying to take advantage of this, trying to make a quick buck that is going to move the market when something like that takes place. So this small dip in yield, considering how much they've have risen over the past few months, in my opinion, is in no way indicative of rates topping here. But there are actually some legitimate reasons to consider that Bill Ackman may be right here. Number one, he's worth $3.5 billion and he manages a massive hedge fund. He is what you would call big money, and big money is typically right. He's also accurate about the fact that the economy is showing major signs of slowing right now. Households' massive buildup of debt, income not keeping pace with inflation, unemployment starting to tick up, people working multiple jobs just to make ends meet, defaults on high interest rate debt like credit card debt and auto loans. And on top of all that, the economic uncertainty from all the things geopolitically that are happening around the world, the inflation from deglobalization, energy prices going up. There are a lot of economic risks to be concerned about right now. And he is right. Historically speaking, for decades now, the safe haven asset has been the US Treasury. When the world gets into trouble, money floods into US Treasuries as the safe haven asset. And there's a final reason why I think his move here is correct that most people will not consider. And that reason is that he's managing a massive amount of money here. This requires scale. When you have large positions like this, you have to have very liquid markets. You have to have somebody to sell to or somebody to buy from. So just the sheer amount of scale you're dealing with as a big money player prevents you from being able to squeeze every dime of profit out of a trade. Think of it like this. Warren Buffett is not going to waste his time buying single family homes and fixing and flipping them. While the return on that may be 20, 30, 40% or higher, and the return that he gets by reinvesting his dividends into Coca-Cola stock are a lot less, he has to deal with scale. To go even farther, you might get 1,000 or 2,000% profit by flipping stuff you buy at garage sales, selling it on eBay. And that may be fantastic for somebody who's not dealing with scale, for somebody who's just trying to make a few extra bucks to help pay the rent. But regardless of how big that percentage return is, the dollar amount doesn't move the needle if you're trying to move $1 billion. That's why moves by big money players often don't make sense in light of economic reality, because they're quite literally moving more money in and out of positions than you could possibly imagine, which means it takes time to scale in, time to scale out, and you have to have liquidity on the other side of the trade. And so even if interest rates on the 30-year Treasury do hit 5.5%, 6%, 7% from here over the coming months or years, this is still probably the right trade for him. And also, nobody ever went broke taking a profit. And clearly this was a massively profitable trade. But there are also some reasons why I think this outlook is incorrect this time around, because the price of anything is always a result of supply and demand. So while it's true that investors may increasingly buy US Treasuries as a safe haven, you need that demand to outpace the supply in order for that to drastically move the price. Now, in 2023, the national deficit was basically $1.7 trillion. Historically speaking, we are only supposed to have deficits like that when we are in the absolute depths of a recession. And even worse, this is happening partly because of the rising interest rate environment. Federal government is paying almost $1 trillion just in interest on its debt, and that it's only getting worse as it has to continue paying off that old low interest rate debt by borrowing new higher interest rate debt. The ballooning deficits, the exploding expenses, and the declining tax revenue are all things that are going to contribute to the government having to borrow more and more, which is just issuing new supply of treasuries. So the idea that treasury prices are going to go up as a result of demand flooding in is dependent on the idea that there's also not an offsetting amount of supply by the government borrowing more and more with its insatiable appetite for debt. And if it's already borrowing record amounts when rates are 5%, do you think it's going to slow down its borrowing if rates go down to 4% as a result of a bunch of buying? I think more than likely that would increase the government's decision to borrow even more as a result of rates being slightly better, pushing rates right back up to where they were. Now, the other big elephant in the room here is the Federal Reserve intervening. Now, most people didn't ever think that interest rates on the government debt could reach 5%. And even fewer people today believe that those rates could reach 10%. The thinking is the government just can't afford that, which means that the Federal Reserve at some point is going to have to step in, print the money. In effect, yield curve control, or at least quantitative easing, will restart in order to keep rates at a point where the federal government can afford it. And since nobody else will be lending at that rate, well, the Federal Reserve will through printing. Now, I absolutely think that that is the end of this road. Rates will go up until the Fed intervenes again. But number one, it seems like that's going to be a lot longer off than we might expect. And number two, it's not going to impact any rates except for the government's rates. So let's break that down. Number one, it's going to be farther away because the Federal Reserve is still trying to fight inflation. They have raised rates 11 times, and now it's at its highest level in 22 years. Even though inflation has come down, it is still at 3.7%, which is much higher than their target of 2%. In the current situation, what is happening right now is the government is just borrowing money that's already in existence. The Federal Reserve is not printing that right now. As a result, it's driving interest rates higher and higher. And as interest rates go higher, that means you actually have deleveraging taking place because the economy can't afford to maintain its existing debt load as the price of that existing debt load goes up. So some of that debt gets paid off. Since we live in a fiat world and all money is just loaned into existence, that means that as debt gets paid off, the money supply actually shrinks. And as we've seen now, there is less money in circulation than there was since 2 years ago in October of 2021. And if the Fed intervenes to print money for the government to be able to borrow through quantitative easing or outright yield curve control, now you are inflating the money supply again. You are printing new dollars, loaning them into existence, and the government spends them into the economy. That expands the money supply yet again. This will reignite inflation. And right now, that's the last thing the Fed wants. But let's say push comes to shove, and whether it takes a couple of months or a couple of years, this is what ends up happening. Well, it only means easier borrowing rates for the government, because as we've just discussed, that will reignite inflation. And now, as opposed to prior to 2020, lenders and investors understand the effects of monetary policy on inflation. Inflation is back for the first time in decades. The market, we know, understands this because interest rates are now at multi-decade highs with even Treasury rates at 5%. Lenders are not willing to lend at a rate that they believe will be a negative real return. And so if the Fed starts printing again in order to finance the government's spending, yes, the government gets lower interest rates, but rates for everybody else will actually increase. Because if you know inflation is going up, then you're not going to accept a 3% return to lend your money on a 30-year mortgage. You're going to demand a 10% return, 15% return, maybe higher. Now, at the end of the day, I do think rates on government debt are going much higher. These things tend to last a lot longer than people expect, and it does not look like the Federal Reserve is anywhere close to restarting QE. They're not even legally allowed to consider something like yield curve control, and so that bailout won't come for a lot longer than people expect. And as a result of the government's insatiable demand for more and more borrowing and the debt spiral from the higher interest rates causing more borrowing in order to pay for those higher interest rates, it seems like rates have much higher to go. Now, I've been pretty consistent on this message for the last couple of years. I have an open position that is short treasuries through the use of put options on TLT, which is an ETF that holds 20-year treasuries. Now, the average investor, number one, doesn't even understand how to short something. They only understand buying something and then selling it. But beyond that, most people, for their risk management, the only thing they know how to do is diversify. So they buy a few mutual funds or they buy a few ETFs and think, hey, I'm invested in 1,500 different stocks, therefore I'm good and I've gotten rid of my risk. That is preposterous because all of those assets move up and down together. There's no real diversification there because their correlation is basically the same. If every asset in your portfolio goes up and down in lockstep, you are not diversified. You have one investment. And so learning how to make very small trades that have asymmetric returns, and if it does work out, you make a lot, that is the foundation to be able to make money investing over the long run because it allows you to do true risk management where you're not exposing too much of your portfolio to one trade, to one investment, and you have the ability to hedge so that if something moves against you, it doesn't devastate your portfolio. And this short position on treasuries by buying puts on TLT is just one very small example of that. And I mean a very small part because it's things like this and much, much more that I teach members of Heresy Financial University how to do in order to decrease their losses. And on the flip side of that, massively increase the returns of their overall portfolio over the lifetime of their investing. I'd love for you to become a member, and if you join right now, you're getting in right at the right time, because on November 1st, we're doing our very first members only live stream where we're going to be discussing strategy, tactics, market conditions right now, the economy, and answering questions from the courses and the lessons. It's $99 a month, which is less than the amount of money most people spend at Starbucks every day. And once you join, the stuff that you're going to learn in just the first couple of days are going to make you much, much more money than that. Link is below. As always, thanks so much for watching. Have a great day.